Hello, investors. Welcome back to Mali Investment Talks with me, your host, Joseph Areo. We've been talking about bonds in the last episode. And we're talking about bonds, especially in the context of the environment, the macroeconomic environment in which we live today. Interest rates going up, inflation has tended to be going up, and monetary policy as a result has been tightening a little bit. Tightening of monetary policy again means interest rates going up, essentially trying to reduce on the supply of money in the market. So today I want to continue that discussion by essentially helping us to understand the risks in the bond environment, in the risks in this market or the environment in which we live today, especially risks to bond returns, the risks that you could have the value of your bonds coming down as a result of what is going on. I need to try and help you to understand what causes such bond risks. Before we do that though, let's understand different elements of bond returns. What constitutes a return to a bond? In other words, when you talk about a profit, a return is like a profit. How do you make money from a bond? Essentially, that's what I want to start by talking about. So, a bond will give you returns in essentially a couple of ways. So firstly, a bond will pay you coupons. We talked about this before. So a coupon is a constant fixed percentage of the face value of the bond, which fixed rate or percentage is paid to you. In our region, it's paid to you twice a year, once every 6 months. So it's a constant fixed percentage. So if it is 10% of whatever face value you have, it will be 10%, but that is usually quoted per annum, meaning you will get 5% per half year. So that is what is called a coupon. It's fixed, it doesn't change. Okay, and that gives this security the description or the title of fixed income. It's fixed, it doesn't change, it's contractual. That is a coupon. Secondly, however, you will many times hear in the industry talk of a yield. A yield is not exactly the same as a coupon. So the yield is the bond income you will get, in other words, the coupon, as a percentage of the price. In the last episode, we talked about bond prices. And we said essentially prices are market determined. It could be par. You could have bought the bond at a discount, or you could have bought the bond at a premium. So the yield will be the actual coupon that you'll be paid as a percentage, not of the face value, but rather of the price. So suppose that you bought a bond with a face value of 100. It's just for simplicity's sake. The face value is 100 and the coupon is 10%. That means you will be getting 10 shillings per year as a coupon divided into 2, so you'll be getting 5 shillings every 6 months. Right? However, Suppose that you bought that bond at a discount. So instead of paying 100 shillings as the face value, you paid 90 shillings, for example. Okay? The coupon rate doesn't change, and it is a rate of the face value. So suppose it's still 10%. That means every year you're getting 10 shillings. But you paid 90, the price was 90. So your yield will be 10 divided by 90 times 100. That will be slightly more than 10%, maybe around 11% or thereabouts. Okay? So you can see that, and specifically that is what we call the current yield. The yield at the time you buy the bond is called the current yield. All right? So as you can see, if the yield is equal to the coupon rate, then it simply means that you bought the bond at par. The price of the bond was par. So in this case, you bought the bond at 100. So the coupon rate is 10%. Even the yield is the coupon divided by the face value is also 10%. If the yield is higher than the coupon rate, then it means you bought the bond at a discount price. Like in the example I gave you, you bought the bond at 90. You are enjoying a coupon of 10 shillings based on a face value of 100, and your yield goes up to about 11%. So you bought the bond at a discount. If, on the other hand, the yield is less than the coupon rate, then it simply means you bought the bond at a premium. Suppose in the example I've given you, you bought the bond at a price of 110. So instead of 100, it was 110. But you are still getting the same coupon, which is 10% of face value. So you're getting 10 shillings per year. So you take your 10 shillings divided by the price. The price is 110. You can clearly see that your yield now will be less than the coupon, to be less than 10%. It means you bought the bond at a premium price. Okay? So learn to distinguish coupon from yield. So when companies are bidding for bonds and the central bank, they would be asked to give their yield or their preferred yield. Okay? Not their coupon, they will be asked to give their preferred yield, and that will determine the price of the bond. Okay? Thirdly, and I'm just mentioning, you don't need to necessarily understand this third one. It's a little bit complicated. The yield to maturity. I just want you to be able to distinguish it from the other metrics that you might hear in the industry. So when they talk about the yield to maturity, it essentially means it's the total return that you will get over the life of the bond, i.e. up to maturity, all right, in relation to the price you're paying today. That is the yield to maturity. It's a rather involving, complicated mathematical computation, which we shall not go into, but just understand that that is what generally they mean by the yield to maturity. But the main thing to understand at this point is the distinction between yield and coupon. Those are two separate measures. Coupon constant. It doesn't change, a certain fixed rate of face value. Yield is not necessarily constant, depends on the market. It is the coupon that you are going to be paid as a percentage of the price. Thank you very much for listening, for watching. I hope this was helpful. Do get in touch with me to get any further insights as you might find necessary. And indeed, do subscribe to the channel so that you can get updated on further posts. Thank you.